Three, two, one, live. Hey friends, how you doing? It's Ernie, and this is a very special presentation today because normally at this time I'm doing a private Zoom meeting with the entire membership of the Asymmetric Options service. And we do a weekly meeting where we review how the trading went that week and also to look at new topics. So I thought I would extend that out and put it out to the world so that they could see exactly what we do, and if it interests you, see whether or not this is something that would attract you to our service. So let me just kind of recap exactly what we do. Generally, we are sellers of options, high probability of profit options. Typically, we sell credit spreads in the 90+% probability of profit arena. Of course, we have our own proprietary methodology for picking those options, but there's no real magic. It really all comes down to good risk management and also to our overall process that we call campaigns. And we're a relatively new service. We've got about 150 members or so, and we're growing. The thing that distinguishes us from all the other services is, well, a couple of things. One is that I am completely transparent with every trade that we take. I take all the trades that I announce in our alerts in my live trading account, what I call my reference trading account for the service. I post the live P&L, the transaction logs, and then distribute the actual brokerage statements at the end of each month. So there's absolutely no hiding, and I do that both for Thinkorswim, which is TD Ameritrade, and also for the Robinhood trades. Now, as far as I know, there's probably a handful, and I can count them. There are less than on one hand that actually do this for their customers. And if you would like to know who they are, I'd be happy to recommend them. I think that they're great services. Other than that, 99.9% of the people out there refuse to show you their real P&L and what they're actually doing. Quite frankly, why? You have to ask yourself why, and it's pretty obvious why. It's because they're frauds. All right, now that's not really the purpose of this. What we're doing here is we're taking a look at we're currently in the third week, or coming near the end of our fourth campaign. Now, what is a campaign? Well, this is one of the processes that we use to help us keep close control over what we're doing, and be able to go back and review our progress, and also institute a kind of continuous improvement loop. So every month of trading is another campaign. At the beginning of that month, we set forth our strategy, the capital that we're going to allocate, and then we take also as input anything that we learned from previous campaigns that we think that would improve those strategies, the processes, etc. So at the end of a campaign, we do something called a retrospective. And the retrospective is where we review the entire month. What we're doing right now is kind of a review of the individual week. And so let me kind of review what this particular campaign was about. We started moving from credit spreads and starting adding calendar spreads because I felt volatility now was had moved down quite a bit, and it was subsiding or leveling off. Now, a lot of people might think that calendar spreads are really for long vega positions. In other words, volatility expectation that volatility will go up. But in fact, even with the election coming, I guess the intuitive thing would be that the election might be should institute more volatility into the market because of the uncertainty. But it's actually quite the opposite. The market is telling us that it is becoming more and more comfortable with what we're approaching into the election. So I think the market is really telling us that they believe that the status quo is going to be maintained, and that you'll see a Trump victory. That's trying to do it from a completely um, now, I have to admit that I am biased, but I'm trying to take it from an unbiased point of view based on what the market is saying. So I think the market is really saying that there is not that much uncertainty in the political process. They think that there's going to be basically status quo. We're going to move into this election. Now, what will happen after the election, that is anybody's guess. The long calendar position is really a kind of a vega neutral or volatility neutral to slightly long vega strategy. And that's one of the reasons why we moved at least one of our major positions into that strategy. The rest of our strategy, we have credit spreads, put credit spreads, sometimes call credit spreads, in a variety of different things, including, one of them actually including the VXX, and because I felt that we were going to have not necessarily be challenged, but I think that we've reached a kind of floor where volatility has now settled down in. And I can demonstrate this by just taking a look at the charts. Let's take a look at volatility. So, since the pandemic, volatility has been coming down, and that's understandable. And even as the election is heating up, volatility is still coming down, and right up into the start, right, just days, literally days before the election, we're kind of leveling off. If you look at it from a much longer term point of view, you'll see that the levels that we're at right now, let's see if I can bring in some more data here. I'll bring in going back all the way back into 2019. The level that we're at right now, if you take a look at this very large volume node and then the area how it's lining up with the volume well just under that, that is fantastic support. And it's supported by this action way back here in 2019 and also coming up to the present day. So I think that what we're going to see is kind of, because we're at the edge of that node, I think the market is saying that there's fair degree of confidence that this level of volatility is the new volatility normal, the new volatility regime. Anything below this would be considered low. Anything above this would be considered high. And so that's where we're at. So that's one of the reasons why we have a calendar spread on. Actually, it's a double calendar with Boeing Airlines, apropos, because they're one of the industries that is probably hardest hit by the pandemic. So these are the positions that we're in right now for this particular. Which measure of volatility do you use? There's two measures of volatility. There's the actual historical volatility, and then there's implied volatility, and we use both, obviously. We use the implied volatility as our guide to what type of strategies that we might use. One thing that you might, now this is a question from the chat. So if you have any questions, please feel free to go into the chat and ask the questions. But typically when we get into a credit spread, a long calendar, we'd like to see some volatility skew. In other words, there's a little bit of front month volatility, or more front month volatility than back months, which is exactly the case that happened when we got into the Boeing Airlines spread. And I can show you what that might look like, what that spread currently looks like. So it's a double calendar, and we actually started off back here on the left-hand side of the equation, and when we put that spread on, we did it with the anticipation that price would be moving up, and it did. And so then we capped it off with a call spread to the right. So, as a general rule, you should never put a diagonal or a calendar spread on that attempts to set the price directly right in the middle of the tent. You have some sort of directional bias, and you try to offset it so that with the anticipation of where you think price might move, and that's exactly what we did. We thought price might move up, and as it moved up, then we added the call spread, which is the right hump, and that was a good move because now we've been sitting here, and if you take a look at Boeing, let's see if we can get a chart up here. The Bitcoin. We don't want Bitcoin. We want Boeing. Let's see, BA. So Boeing has really settled in and is just moving sideways, which is really the perfect environment for what we're looking for. We don't expect any huge moves up or down. I think after the election and as the economy becomes more normalized, I think you're going to see Boeing start to gain some real strength. And as businesses come back and more people are flying and there's less fear about being on the airlines and so forth. That's one thing that I think that needs to be fixed, and that is this endemic fear that is being pumped into the economy, into the culture by certain political operatives. I think that with Trump coming in, I think that a lot of that fear will subside. He's bringing a message of optimism, at least from what I can see in the last debate, where it seems to be the exact opposite on the left side of the equation. They really want to inject nothing but fear. They want to lock down, and that's something that the market doesn't want. And I think if the market felt that that's what we were heading towards, you would see a lot more volatility in the market. So anyways, sure, I'm talking politics here, but the real the reality here is that the two things that affect the markets the most is geopolitical conditions, the culture, and geoeconomic conditions. All right, and so that's just a reality. So you need to be in tune. Now, if you have a political bias, that's okay, as long as you can step back and kind of look at both sides and think, and then see how the market is reacting to both sides. It's not the easiest thing to do, particularly if you have a bias, because you'll be rooting one way or the other, or wondering, why the market is doing this. But it is a challenge, and that is to step back and see what the market is telling you, and the market will generally tell you what is going on. I guess your interpretation can be one way or the other, depending on your bias. But that we're in a political season, so that has to take into account what we are doing. And what we are doing here is we're trying to play volatility based on what we think the political landscape is. Okay, we have a question. Where would you use a single calendar versus a double calendar spread? Well, a double calendar spread is really a reaction, and that's an adjustment to the spread. So I would always start off with a single calendar spread based on where I think the market is going, a calendar or even a diagonal. A diagonal being where I have some offset on the legs so that I can create a little bit of bias from one side to the other. And that's exactly what I did with Boeing. And then if it goes in that direction, I'm fine with that. But then what I'll do is if it goes positive, then you would add a call calendar to that, or a call diagonal. If it goes to, in other words, you would sell a call diagonal. Or if it goes to the left, then you would put on an additional put diagonal, right? So it depends on the direction, and then you do the adjustment. So putting on a singular calendar spread and then trying to adjust just that calendar spread doesn't work out so well. You're going to limit yourself in terms of your total profitability and your ability to adjust and widen that profit tent. So that's what we're doing. And as we're going into after or post-election, I think both credit verticals and calendars are going to be prominent in most of the trading that we do here. We're also going to start taking up some more short-term trading using not zero DTE or days till expiration trades, but something more on the lines of 2 to 5 days to expiration, and playing the intra weekly expirations on things like the indexes. And I think there's great opportunity there to get in, get out of high probability trades, and chip away at this market. And so that's going to be part of our next campaign, which will be campaign number 5. Now, let's see. How do you overlay your spread onto TradingView with POP? All right. So in the chart, what Sam Marks is referring to is this. Now, I don't do everything. I just put this text in here. I don't put everything in here. This is not something that is provided to you by TradingView. So what I do is I create a graphical representation of my trades by showing where I think the expiration is going to be, and this is how I will present a trade to somebody or to the group. So here's other examples of a Twitter trade that we just took on last week. Actually, I believe we took this in the Robinhood account. But anyways, I will show what that trade looks like graphically, with the right side of the rectangle being, indicating the expiration date, so that you can see graphically where you are, where the profitability is, and that gives you a good feel for whether or not you believe that this is going to be a profitable trade or not. In this particular case, we have a pop of 81%. The second side, 82, is our P50 number, or where we think the probability of getting 50% of the credit. But there are other things that are going into play here in terms of the volume profile that we also use in this decision-making process that I believe brings that pop into a higher category than 81%. The 81 is really based on the Black-Scholes model, or the theoretical idea of what probability is. But there are other things that add to probability that are beyond things that Black-Scholes and the other types of probability models do not take into account for. All right, let's go. We get more questions. So this is basically how our meetings go. Members come in, they ask these type of questions. We go over them. We pick them off as points of reference, and then later in the week, during the week, I will prepare other lessons that specifically answer these in more detail. Abel's asking, I actually didn't catch the call spread part of the BA trade. Still worth? It's at 2 cents debit. No, I think it's a little bit late for the Boeing trade. We've been in that for quite some time, and we've built up quite a bit of capital in terms of collecting credit. Marlo saying, do you expect a big spike in volatility after the election and into December expiration? I really don't know, right? So I think more likely we may even see a drop in volatility unless some sort of social upheaval happens. And why do I say that? Because, well, volatility has been dropping as we're heading into the election anyways. And a lot of people thought, so similar to an earnings report or a new product announcement, typically volatility rises into those type of binary events. But in this case, volatility has been slowly dropping. And so I think that after the event, the only thing that's going to really make volatility rise, is some sort of cataclysmic political event or economic event that will inject more uncertainty into the market. If that doesn't get injected into the market, there's no reason why volatility should rise. I think, in fact, it may even drop. So, but I'm not making those predispositions yet. I really don't know. I just want to put on positions that I think will work right up to that event, and then we'll take them off, then see what volatility does, and then react to that. Paul's asking, hello, I just signed up a couple of days ago. Are the Zooms the best way for a newbie to learn the basics? I think you're referring to now inside the website. We have all of our videos archived, and there's a lot of material in there. But in terms of learning the very basics of options, I would recommend that you go to like Tasty Trade and take their options course, and then particularly focus on credit spreads and calendars and diagonals, because that's what we'll be mostly employing. Now, while we take over from the basic part and go forward, that's what I would recommend. And also, when you first get on, as you see from the startup document, your first task is to make sure that you have a level 3 authorization with your broker so that you can trade credit spreads and calendars. But once you're beyond that, and it shouldn't be more than a weekend or a week's worth of study to get up to speed, then we take over from there. And then when you're inside of the room, we'll provide all the support that you need. There are dozens of videos inside the paywall that talk about our strategy and our process and the specifics of the trades that we make. I was watching the video about explaining the way market makers hedge their position. Do you think this is viable? No, we are not market makers. So market makers are really they're not there to necessarily hedge a position. They naturally hedge. I mean, that's what they do. But the hedge is really a function of putting liquidity into the market. They're providing both bullish and bearish positions at the same time for people who are both bullish and bearish, opposing those. I mean, that is what a market maker does. They put in these sort of neutral positions, and then they make money off of the spread, right? So they're not really trying to take advantage of where they think the market's going. They're just trying to take advantage of the spread and provide that liquidity. I mean, that is their fiduciary duty as market makers. All right. So that's where we're at. Let's see. We'll go back to the trades and describe those in a little bit more detail. So as I said, next week will be the end of campaign number 4. So far, we have been shooting for our target each campaign is to make somewhere between 4 and 7% return, and hopefully that will stay above the market returns. And so far, we've easily beat the market every single time. So our first campaign, we were at about 9%. Our second campaign, a little bit over 10%. And our third campaign, we were at about 1.5%, which was actually still 6% ahead of the market because the market was down during that period. And this month, I believe we'll come in probably somewhere around 6 to 8%. It could be higher. But I think that we will still be hitting that sweet spot so that we are averaging somewhere, around 7 to 10% per month. Now, that's really on the high side of my expectations. As I said, it should be somewhere more between 4 and 7%. So if that is something that interests you, to make that kind of consistency and to have the transparency, as well as the coaching and mentoring that you would get, then I suggest that you join our service. It's extremely affordable. We design it around people that have small accounts, but it is scalable to very large accounts. Next month, I'm going to inject more capital into the reference account, and actually I'm going to create a second reference account for people who have a little bit more capital. And so we'll use that account and have other trades that may be a little bit more capital intensive. So then we'll be able to serve people at all ends. So we have the Robinhood account for very small accounts, Then we have our first reference account for people who start with a minimum size brokerage account, say $2,000 and up. And then we'll have a larger account for people who are at a different level. All right. Are there any other questions? If not, then I'm going to wrap it up here. I think that we've covered everything. Well, actually, I think we haven't really totally covered all the trades, right? So why don't we just do a quick recap of the trades? So as I said, we have Boeing. Now, Boeing, I expect its expiration, by the way, because it's a calendar or diagonal, is the 6th of November. I timed it just after the election, and I expect some volatility might kick up, and if it does, that may help the position a little bit. But I think that what we're looking at is, well, if we look at the analysis tab here, it's kind of hard to see here, but I think that we're expecting somewhere between $100 and $152 per contract return on the Boeing. And then for Netflix, we're sitting right here nicely underneath the profit tent. I believe that we'll come very close, perhaps collecting the max profit here as well. So I expect our overall, between that and well, we also have Goldman Sachs trade here, which is doing well. Let's take a look at that. All right, and that's a bear call credit spread, and you can see here that's well inside the profit zone. In fact, the one standard deviation move is suggesting that we'll have max return on that as well. So everything's working out great. Our VXX, even our VXX is doing well, and that is also inside of the profit area, and very good chance. I think that this break-even point is well below the volume node where I'm showing, and we'll close this well before the election. It's set to expire on the 6th, but we'll likely close this once theta decay starts really kicking in, and we'll probably get another $30, $40, $50 per contract. So it looks like all of our positions are going to end up profitable unless something drastic happens. And anything can happen before this election, anything. But I think we're in pretty good shape. Looks like we'll easily get to that 6 or 7%. We may even get above 10%. And then I believe right now we're at about a 25% return after about 3.5 months in operation. So by the end of this campaign, the end of this month, I believe we'll be up around 30, maybe low 30s for return on the total capital that we're using for the first 3 months of operation, 3.5 months of operation. The first campaign was only half a month, so it'll be the first 3.5 months of operation. All right, again, if you're interested in that, just go right here to asymmetricadvisor.com/options, sign up. We'd love to have you. We're growing. We provide first-class support, completely transparent on all of our trades, everything that we do, really unique in that area. So you get the best of all worlds. Excellent price, value. You get coaching and mentoring directly. I am live in the room all the time. I give all of my customers my phone number, believe it or not. You call, you talk to me. And completely transparent, showing our P&L, transaction logs, and our broker statements for every trade that we make. All right, that's it. I want to thank you very much for showing up, and we'll see you next video. This is, as I said, a kind of a special deal. This is what our normal Saturday meeting looks like. We do this every Saturday. Next Saturday will be our retrospective, which will culminate the end of campaign number 4. All right, and then I'll get back to normal public viewing videos. All right, take care. Thank you very much for the questions.